Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to the policy that's coming out of D.C. fast and furious. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. Okay, so if we get this news out of Mexico that Trump and Sheinbaum spoke and they're going to delay tariffs by a month while they work out other stuff, does this mean that we know why tariffs are being put? They're being put as a negotiating tactic, full stop. Is that now correct?
So I certainly think you can think about it from President Trump's point of view in terms of his goals. Obviously, when he's talking about our trade imbalance or our trade relationship with Canada and Mexico, he's mentioned three things in his Truth Social posts: fentanyl, border security, and the economy. But from the Canadian and Mexican perspective, it's much easier for them to go to President Trump and say, look, we'll do something on fentanyl and border security today. We could take a longer term approach to the economic imbalance. That's certainly something that President Trump still wants. But from a negotiation perspective, I'm all surprised by this because it was what they could give President Trump in the short term. And we'll see what this meeting with Justin Trudeau today at 3 p.m. Maybe Canada has a very similar proposition for the president. So,
I'm not even sure where to go here, but I guess as you kind of phrased it there, Nathan, this is a president that likes to negotiate, he's transactional. And it seems like if the counterparts are equally transactional, that maybe you could avoid a wider trade war. Is that kind of the expectation for the folks down in D.C.?
Yeah, so if you're part of the bull case, I think, in terms of that, President Trump is a negotiator and so forth, this is fitting into that narrative. Obviously, you do have to prepare for tariffs because we do think tariffs are coming, but it just really depends on the sectors and also the broad impact of those tariffs. So let's just say that if Justin Trudeau, the Prime Minister of Canada, and President Trump make a deal today at 3 o'clock, and it follows the same timeline as Mexico, you get 1 month, President Trump is eventually going to come back and say, okay, well, let's talk about those trade imbalances. Let's talk about, in his Truth Social posts, about making Canada the 51st state. But, again, it's about extracting concessions. So what do we have to do for us in the market side? You certainly have to prepare for it. But also at the end of the game, it's very difficult to call because it's just one man's decision. And so we're just going to have to stay tuned and see what happens.
All right, so that's a great point. Stay tuned. What are you staying tuned for? Like, what are going to be the key phrases, the key words, the key pressers that you're going to be watching out for to tell you what the reality is going to be?
So I'm actually looking for whether or not Canada and Mexico follow through, or at least threaten to follow through in terms of their export taxes. For example, potash. Not something many people talk about, but 90% of potash in the United States, which is very important for our fertilizer industry, comes from Canada. So if Canada wanted to, put on economic pain on a certain aspect of the American system, and especially a system that is voted for President Trump, I certainly want to look for something like that. Because for me to see the changing of the guard, or at least pressure on the president, I have to see it coming from the trade associations here in Washington. Not the big ones like the U.S. Chamber, but smaller ones like the National Association of Manufacturers, or the fertilizer, or the farmers. They're the ones that can put pressure on their allies on Capitol Hill to go to the White House and say, President Trump, you need to step back. So retaliatory tariffs is not something we talk about here much in the United States in this context, but that's really what I want to see if President Trump eventually would move away from these threats.
How about China, Nathan? We have, obviously generally very good relationships with Canada and Mexico, and presumably that helps in some negotiations like we saw with Mexico this morning. How about China? What's the feeling within the Beltway about how the U.S. may approach China?
Yeah, that's a great question, because a lot of the airtime right now, and certainly a lot of time in Washington, is spent on this Canada and Mexico relationship. But it should also be said that China received a 10% increase in tariffs as well. Now, we saw the response from the Chinese government that was more muted in particular. There wasn't any retaliatory tariffs at this point, at least. But I think that's certainly going to be part of a broader discussion. I think the folks here in Washington feel that when it comes to the U.S.-China relationship, they can at least take a breath. Things aren't going to be moving at lightning speed like they are in North America. There can be a little bit slower aspect towards those negotiations. But again, this is certainly coming. And don't be, the European Union, they're most likely next as well. President Trump has a lot of areas around the world that he wants to move into in terms of tariffs. Canada and Mexico and China just happen to be the first one on his list.
But if we're learning anything from the market action in relation to these headlines, it's that don't trust your first reaction. I mean, you're just looking at it. If you look at the S&P mini futures market that takes into account yesterday, this morning, and then now today trading, it's a whole different world. So how should a market participant think about this?
Yeah, so there's a lot of sentiment right now, and I agree with this sentiment that, in terms of these threats, we're beginning to see that it's just the same playbook of that transactional president that he's willing to negotiate. It's obviously difficult for those of us in the markets to try and figure out what President Trump wants from those negotiations, but I think anytime you see one of these tariff threats / opportunities that come up, always just keep in mind that there is going to be a negotiation that takes place. Whether President Trump is talking about fentanyl and border security, those are things that the Canadian and Mexican governments can easily control, like Mexico's example of sending 10,000 troops to the border. If President Trump's number one demand is an economic imbalance, like with the European Union in terms of increased share of GDP spending for its defense, that's a longer-term thing that the European governments would have to put in place. So I would just say, what is President Trump's number one goal here? What can the other countries give in exchange? And can there be a negotiation time frame that's long enough to not spook the markets?
Well, tariffs certainly have the market's attention today, but tomorrow is another day. What, from a policy perspective, are you and folks in D.C. kind of looking towards this Congress, this administration to move forward on? What are the important ones coming up?
Yeah, so this week, obviously, we have confirmation hearings. I mean, I think most people think are going to get through. Tulsi Gabbard, I think, is the one that if she were not to get through, I wouldn't be surprised by that. Jameson Greer, who's the U.S. Trade Representative, his confirmation hearing is on Thursday. Certainly important because he's going to be one of the most important voices in this administration towards tariffs. So a lot of questions may be asked. Hey, why would, we do this if potash and those farmers are going to be harmed? But I would also point out that the House Budget Committee is trying to come up with their reconciliation blueprint about this is the instructions for this major multi-trillion-dollar tax extension bill. And if they can't get it done, that serves our narrative that this is going to take a lot of time to work out. And if you lose any votes, and for example, the Republican Study Committee has already said they're not going to support anything that doesn't decrease the deficit, well, how do you include things like no taxes on tips without decreasing the deficit? Right. It's an extremely difficult question. And so I think we're going to be looking to see what those negotiations take place as well.
Can we just switch gears for a second and talk about the Elon Musk and the government and what we've seen from him and Doge in the last 24 hours?
Yeah, so obviously, we've seen reports over the weekend that the Doge committee is in Treasury, accessing Treasury payment systems. This is with the idea that eventually they could cut off payments in wake of the federal freeze executive order that was then rescinded. And this is an idea about impoundment. And I think this is something that's coming to the courts. And even if you listen to Elon Musk last night on his Twitter Spaces or his X Spaces, he even said that he may need the court's support in this idea of impoundment. Let's just say that Congress decides that if they're going to give $100 million to the Department of Education, President Trump could just come back and say, nah, I'm not going to pay for it. But somebody is eventually going to sue over that. That will eventually get to the Supreme Court, and there are already laws put in place about impoundment. So it's sort of unclear, does the president have the ability to say, we're not going to spend this money? But look, if from Elon Musk's perspective, there's a lot of regulatory red tape, there's a lot of bloat in the U.S. government, we should certainly try. And it looks like they're starting with the USAID first.
What's the feeling in D.C. about Doge here? Is this a credible, effort, if you will, organization, if you will? Will actual change happen?
So I think if you talk about the internal structures of the U.S. government and specifically within the executive branch, so agencies like the USAID, President Trump and the Doge Committee can do a lot of work in terms of restructuring it and also going back to that impoundment fight that I just mentioned, shrinking it. I think you have some Republicans who are completely on board with that idea. You have also some Republicans who are sort of uneasy about the idea that the White House would then have the power to just take back this spending. Because, look, eventually we will get a Democratic president back. And when a Democratic president comes back, he or she may be able to say, well, you know what, I'm not going to spend these policy goals that Congress has implemented as well. So I think there's some unease amongst the Republican Party that he's doing this, but also he's supporting the narrative that there is a lot of bloat in the federal government. And so I think it's just one of those, again, stay tuned and see what happens over the next few months.
All right, Nathan Dean, thank you so much. We appreciate that. Stay tuned. Every day is a new day in this news flow.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's take a look at what you do in this market. Now, I'm taking a look at S&P mini futures contracts. We are off the lows of the session that we hit earlier in the morning before the cash open, so keeping that a little bit in mind. Carol Pepper, founder and CEO at Pepper International, joins us. So, Carol, begs the question, do you buy this dip?
Yes. Well, as you guys know, I manage money for families with over $100 million who are typically family offices. And I would say wait a little bit longer to see how much the dip is going to dip. This is a dip. It's a 2 to 4% dip, not bad. You can buy this dip if you want to, but we may, if it looks like these tariffs really will be implemented, this is just the beginning of a dip.
Right. Well, just a red headline crossing the Bloomberg terminal right now. Mexico's Scheinbaum says tariffs delayed for a month. So we'll have more reporting on that. Apparently, the Mexican president had a conference call earlier today with President Trump. So perhaps some relief there. Carol, as we just kind of step back here and think about some of the volatility or the news flow that tends to come out of a President Trump administration, how do you tell your clients to kind of deal with that?
Well, I think you have to, again, keep your eyes on a longer term prize. What sectors over the long term are going to do well, not within the first 30 days of a brand new administration, but what trends that have been true for years are continuing to accelerate. And I think those trends will work no matter what comes out of the new administration's strategic statements in the first month as they're trying to, put their stamp on the government. Mm-hmm. So if you look at things like defense technology, the entire world has burned through a lot of weapons. That is going to continue to be upgraded with AI. There's going to be more robotics. There's going to be more drones. There's going to be more data centers. AI is not going to go away. Consumers are going to continue to switch and shop on Amazon rather than in bricks and mortar stores. All the things that we've been talking about still apply today with the threat of tariffs, if they're now or in a month or two. So you still have to keep your eye and then think about entry point. When should you enter these stocks? And so that's really what we're doing. We're not changing our basic thesis because we do believe it is going to continue as we suspected. There is more risk off in the market. That means that's going to depress the growth stock prices, which is good news for you if you're long-term bull. If you're long-term bull, you kind of like this time to have an entry point and even a little bit more slippage. Maybe we'll get a 5 or 6% down on some of these big names. Wouldn't it be nice to enter 5 or 6% lower?
A week ago, we also, speaking of AI, we would have been talking about how the AI hyperscaler spending theme is pretty intact no matter what happens with tariffs, and that got disrupted. Is that still sort of a major core theme for you?
Yes, absolutely. I mean, I talk to a lot of folks who are busy building data centers. There are energy and data centers are getting very intertwined. So people are off taking energy that before they might have made carbon credits out of it and capturing it and making data centers in places like middle of the country in Oklahoma and places like this. So those themes are going to continue. Wealthy families are piling into the construction of data centers, whether the chips are NVIDIA or someone else. The data center construction isn't something that takes a few days. That will continue to create jobs. So data centers are still a good play. They're already started, they're already under contract, and they're not going to stop just because a tariff is imposed.
Carol, how about on the fixed income side? How are your clients playing fixed income these days? They can actually clip some pretty competitive coupons these days.
That's right. I think it's so hard to tell in fixed income because we really don't know yet what are going to be the effect of the tariffs on potential inflation and what Powell can or cannot do. Obviously, real estate to me is still a sector at risk. It's been holding on by its fingernails now for a few years. Extend and pretend. That might have to go on a bit longer now if we have a situation where inflation ticks up, if there are indeed tariffs imposed. That's going to make it very hard for Powell to lower the rates and therefore give some relief to real estate. So that's a sector I think people need to kind of watch out for. I don't think we're out of the woods yet on real estate. But you're right, in the short term as well, not a bad time to have a little bit of fixed income, but more on the shorter side because the swings on the long end are not worth it for most individuals. That's much more an institutional play.
What about safety plays? Like what do you recommend to your clients that just need a portion of their investment portfolio that's safe, it's liquid? Like, is cash still the place?
Money markets and cash. Some people like gold. Bitcoin was looking exciting, but look at what happened with Ethereum. It just sort of collapsed now that the environment looks a little bit more risky. So yes, I think cash is still king. It's always been king. It will continue to be king. And US dollar cash is still the king because it is still the world's reserve currency. Other countries might try to take that position, but I don't think it's going to happen anytime soon. So sitting in cash is no shame in making some decent returns in your money market fund while the dust settles. Absolutely a straightforward play.
Carol, thank you so much for joining us. Carol Pepper, founder and CEO of Pepper International, joining us again.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The story today for global markets, global Wall Street, are these tariffs and the economic impacts that they may or may not have. Bryan Whalen joins us. He's a chief investment officer and the Generalist Portfolio Manager at TCW in Los Angeles. Hey, Bryan, I know you and your team, you think kind of about global markets here. How do you guys think about kind of just tariffs in general? We're not really sure what degree they'll be imposed, for how long. How do you guys factor that into your calculus?
Yeah, it's hard. What a morning, huh?
Yeah.
Can you believe DeepSeek was just a week ago?
Right,
Feels like
exactly.
Look, I think the term we've been using around here, we're using the term fat tails, which is just kind of a reflection of, like, in a traditional investing environment, you've got your base case scenario, maybe you got a 70% probability assigned to it, and then you got your two other options. You got 15% to the downside, 15% the other way. I mean, with regards to, this new administration and the volatility, fat tails for us means we still have our base case, but, there's a lower probability on that. And then we've got, maybe something like a 50 in the middle, and then 25, we have this U.S. exceptionalism, high growth, low inflation on the other side. Maybe a lot of this tariffs, for instance, cause a pull down on both domestic and international growth, and it upends the job market, and maybe we have a recession. And so for us as portfolio managers, what we think about at TCW is, like, you still got to construct around your base case, but in an environment, particularly one where it's not that expensive to buy optionality. Volatility is still low, at least the priced one. You try to do things that, help your portfolio either not lose so much if it goes one way, or maybe even gain if it goes another. And that's kind of the things we've been doing in the last couple of months have to do about putting things in place in the portfolio that actually help, even if our base case isn't realized.
So, Bryan, why is volatility, and I'm just looking at the MOVE Index, it's the JP Morgan Volatility Index, why is it low?
Well, a lot of that, I think, what's transpired, from the Fed, particularly once we got into the late months of 2024, and even what you just heard him say, Powell say last week, which is basically, we're good, which is, we kind of like where, the Fed funds is right now. We still think it's restrictive, but given all the other volatility going on, particularly tariffs, for instance, we're going to kind of sit here and kind of watch things. So what that's done is it's anchored. It's provided stability to the front end of the yield curve, and particularly somewhere between like 2 years and 5 years. It's anchored there, and it's left the rest of the curve, the 10-year and the 30-year, to kind of move up and down. And so, with the fact that the Fed has moved into this kind of pause/easing mode, it's led to the implied volatility in the rates market to be relatively low. However, what I would say is, and we can get back to tariffs and other things going on in the markets, like, that's conditional upon risk assets performing well. And if we get moves in risk assets, particularly to the downside, you could see that implied vol in the rates market go away and rates move abruptly if we get downdrafts in equity markets or widening in credit spreads.
So talk about credit here, Bryan. How much credit risk are you guys taking these days? When you look at a 2-year treasury, you're still getting 4.25%. How much above and beyond that do you want to take in terms of credit risk?
One of our favorite trades right now is not to have that on. It's not to take credit risk. I think you're being, fairly well compensated to take no credit risk, which is effectively, treasuries. And, you've never been paid less. And that's hard to believe given, DeepSeek a week ago and tariff volatility over the last 24 hours. And, Trump's being Trump, and all of a sudden, we spent 24 hours cranking through the models to determine how these tariffs are going to impact inflation and growth, and all of a sudden we get a big, just kidding, and that creates vol. So you've never actually gotten paid less to take credit risk right now. To get paid, to take exposure to kind of average high quality companies right now, it's about extra 0.75% of yield over treasuries, and that's never been that low. So look, you win by buying that right now if there is no vol. If the next 6 to 12 months it's very low vol and you don't get uncertainty and markets don't move around, and that's the carry trade. You win. You lose if we do get bouts of vol and things bounce up and down, or particularly wider. Because when you get in such a little premium of compensation for risk, when spreads go from 75 to maybe just 100 basis points, 1% over treasuries, that's going to impact the value of your holdings, and you'll be wishing you saved your dry powder. You'll be wishing you bought treasuries instead of corporate bonds, because you'd wish you could buy them at cheaper levels.
All right. We really appreciate it. You're awesome. Bryan Whalen, CIO and Generalist Portfolio Manager at TCW's Fixed Income Group. Great perspective on the fixed income market.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.